Welcome to the Tearsheet Challenger podcast. I'm Zack Miller from Tearsheet. With me is Josh Liggett. Josh?
What's up, Zach?
And we're here with episode 12. 12 painful episodes. Just kidding with that one. But I guess today's big topic is the Plaid Visa tie-up. Josh, you want to tell us what happened there?
Yeah, we got to get our Boston accents on for Plaid.
Plaid.
Coming out and getting bought by Visa. That was a horrible Boston accent, but you're welcome. Visa bought Plaid for $5 billion in cash and a little bit of debt. So it's pretty awesome when you can just have $5 billion in cash lying around to buy a really awesome, payments provider, whatever Plaid, all the fun stuff that Plaid does, the connections, data aggregation, all the crazy things that Plaid provides to the marketplace. So it's pretty big news.
Yeah, I think so. It definitely got everybody in sort of fintech excited because it was a 2x, I think, step up on their valuation from their last round. So that gets people excited, particularly investors. But I thought we would just spend a few minutes talking about maybe what this means for the banking ecosystem. Obviously, Visa, one of the largest financial institutions in the world, one of the largest institutions in the world, building a tremendous, I think, a very powerful and broad ecosystem themselves on their rails. And now all of a sudden they're going out and buying a data aggregation platform, Plaid, which really, handles, when a user signs up at an account and they want to connect their bank account, they want to connect the company they got a loan from, Plaid goes out and kind of aggregates all that data content and then serves it up to an individual app. And so, this, in my mind, this is another step ahead for Visa in terms of their inroads into the fintech community. Plaid, there are a variety of players in the data aggregation industry. Plaid has a reputation for being well regarded and used within the fintech community. So like the Robinhoods and Coinbases and stuff like that use it. And so Visa has been, over the past few years, really focused on reaching, I guess, into earlier stage companies and getting them up and running and working with Visa and up on, VisaNet and using their tools, even push payments. This gives them that inroads into Plaid. And obviously Visa works in 200 countries around the world. They can take Plaid. Plaid had begun to go international, I think, to the UK, but this actually enables them now to go global with this. This is like sort of the, unsexy underbelly of what kind of modern finance operates on. And Visa's sort of acquisition, in my mind, sort of validates this whole space. Even though it is unsexy, if you want to aggregate data, you're going to need to go through one of these platforms at some point.
I think this embodies everything we love about fintech that you and I talk about, which is like
love
sexy,
in air quotes, or
love quote unquote, is that like
okay.
The sexiest fintech is boring fintech. Like this boring stuff. The news dropped. The news dropped on one of my groups. The OMG, oh my God, I like threw it onto another two groups, from a bunch of my friends and a bunch of my VC buddies, and like most of the people who aren't in fintech are like, what do they do? Like a lot of people who aren't in fintech don't understand what they do. Like, why is Plaid important? What are you talking about? You start talking about data aggregation and all these different things. They're like, what? But at the same time, this is a product that is the underpinning of fintech, of like open banking, of these opening things up between connecting, exactly what you said. And that's vital. And that's incredibly important, vital for the expansion of digital fintech solutions out there. So like, I think the industry, the insiders and the industry experts all understand the value of a company like Plaid and see how, I think why it can't be a bad move for Visa. I mean, why not? They're pretty awesome. And then, everyone loves Plaid,
Spoken as a true shareholder. Yeah.
I wish I was a shareholder. Amex is a shareholder. Visa. Amex was a shareholder in Plaid also, by the way, which is interesting. And I think Citi and so many banks in fintech were shareholders.
Visa and MasterCard were also both in Plaid earlier. So one of the things I think that's interesting is there has been sort of a hullabaloo around screen scraping, which is a technique that some of these aggregators used earlier on in their evolution to basically, to log in using a user's credentials and kind of just through a bot, just kind of sucking all the information out of there and put it into other apps. Now that's kind of shunned and frowned upon by many of the big banks. And over the past year, we've seen a few big banks, including Capital One and JP Morgan, turn off Plaid, block their access to their system. Obviously, these companies want to provide their own APIs, probably want to monetize their own APIs as well. So I don't know, maybe having Visa on Plaid side, I almost said Plaid, it
It's
helps.
hard. It's hard. It's hard not to say
It's a
Plaid,
hard word. Yeah, I understand. I understand where you're coming from. No, but so maybe Visa's polish and Visa's presence and size in the industry helps Plaid maybe even land more of those big bank relationships. So JP Morgan basically came out last week, and I think it's worth mentioning here that they were going to block any type of screen scraping and all the data aggregation. And going forward, I think this is beginning at the end of the year or next year, we'll have to go through one of their approved APIs. And so that, we're moving, I guess, from the first stage of sort of data, this sort of crude data aggregation to more push and more bank control type data. And, they make a case around customer data security, and you don't really want an aggregator coming in and just sucking everything out, because from a consumer's permissioning point of view, you want to give the consumer exact control over what they share and what they don't share. And when you have an aggregator, it doesn't always work that way. It's kind of brute force type thing. So I guess this puts a little more polish on the data aggregation industry and the relationships with some of the big banks.
I think it also, I agree with you. It does do that. It also, you could get to a point, sort of the Robinhood factor, if you want to call it, where if somebody's coming out and doing something to such an extent that it's disrupting the industry, you're going to have to, make a change, as seen with brokerage accounts with free trading that just happened the past year, which took them 6 years to get together, to make it happen. But I guess JP Morgan says, you can only use these companies, you can only use these APIs. And then if there was a movement where other banks and other fintechs and other companies are just using Plaid or using whoever it may be that's on the not approved list, it could be that they have to, change their tune. I could see that happening also. It's also hilarious when all of a sudden, the customer data becomes such a focal point at certain points. You can, when it, like with Facebook and all these other companies where, obviously they're using a lot of stuff to monetize on that data. And I always find it comical when all of a sudden you're taking a lot of companies taking the high road, quote unquote, when it's convenient to them, if you know what I mean.
Yeah, I hear that. One of the things I think that's interesting dynamic in this industry that we've learned about in Tearsheet's coverage of data aggregation, a lot of these guys compete against each other. So you have Plaid, you also have MX, you have Fiserv's solution, you have Finicity, and even though they compete, they also collaborate in a way because there's so many different points of data. And so many different accounts and different types of institutions. Like, it's rare that one data aggregator has access to all the, whatever bank or financial institution their customers are going to want to access. So they'll actually go out and reach out to another data aggregator that they compete against to be able to bring in that information. And so also, from the banking point of view, from the institutional point of view, they make deals with a variety. They're not limiting their data sources to a single data aggregator. They're going to provide that to multiple players because they also want to provide that service to their customers, or at least they'll be forced to. Anyway, I think it's an interesting business. I mean, we'll see where Visa takes it. And as you said, it's sort of a validation, or at least a funny validation of sort of the fintech thesis. But it's a non-sexy business that really is in a way, the oil of the economy, the financial economy is this data piece. And I think we're going to continue to cover that in this podcast, as well as our coverage. I don't know if that's something you're particularly investing in, Josh. That'd be interesting.
I mean, this is something that's really interesting. Can I just take a second and thank you that we spent all this time talking about an incredibly interesting fintech, piece that has strategies and like so many moving parts and are really changing digital things, as opposed to talking about stupid colors of credit cards that we start every single podcast. I would rather spend, I'm so happy that we just had like an interesting discussion about data aggregation and whether or not things are going to be opening up, as opposed to we just made a royal blue credit card that we're going to try to onboard more users for. This is, to me, the stuff that's so interesting about fintech and is really, really cool. But the problem is, to most of the world, it's boring as hell. and exactly like you said. And I love boring fintech. I mean, a lot of the data aggregation, when you have a company that's so big, you know, a couple of names you mentioned. I mean, now with Plaid, with Visa, which now Plaid turns into like part of a $500 billion, you know, behemoth basically. And then you have Fiserv, which is also a monster, you know, $80 billion, $90 billion market cap. It's sort of hard to get into that space when a lot of it has already happened. You know, definitely looking, data is obviously the new oil, and any type of data aggregation play is very interesting. It's always a question of timing in the market. And, you know, like the question that we sort of spoken about offline and a couple weeks ago is like, investing in a challenger bank seed stage right now isn't necessarily the greatest idea in the world with all this, you know, all the people out there. But I'm just happy we're talking about this and not colors of credit cards.
Well, that's a great segue, Josh, because actually we published on Tearsheet, we published some research this week. We reached out to, I think it was 172 financial professionals, and we wanted to get their view on what they thought of the challenger banks, how competitive challenger banks were to each other, and how competitive they were to incumbents. And so I would 100% agree with you on the consumer side, even though, you know, there's certain level of things being overhyped. We saw that in the research. But on the business side, on the commercial banking side, nobody ranked well at all. And so to me, most interesting. So, you know, we asked them to rank out of 1 to 5 scale, 5 being the most competitive. Nobody scored over a 3 on the commercial side of the challenger banks. We've talked about some of these on the show. You've got Aslo and Axos and Novo. Yet when we asked professionals to rank challenger banks in general and their potential to be competitive in the commercial banking side, that was actually the highest ranking there. So that ranked higher than all the individual rankings. And so in my mind, that just means that at least the industry sees that you know, they're bullish on the fact that a challenger bank can come in and be competitive in commercial banking, but we haven't seen it yet. And so I just wanted to throw that in as a you know, sort of an addendum to what you had just said.
Yeah, I think it's a very clear point that these challenger banks are awesome. They're really cool what they're doing. And the question is like, yeah, have we seen the one that's going to be the really interesting one? Has it been created yet? Is it going to be a spinoff of something? Where exactly going to be? And I couldn't agree more.
And so, you know, we're starting to see like, you know, I guess early stage of maturation of some of these companies. And we had Starling Bank, a UK-based bank that is going international, come out this week with an interview that said basically they're not planning on exiting to an incumbent bank, because that's sort of an anathema to why they were founded. But instead, they were looking to break even next year and go public in 2022. How likely do you think that is, Josh?
Wow. Well, I haven't looked under there.
Softball. Yeah.
Let's just, why shouldn't they just act like they're just IPO right now? Why do we have to wait for 2022?
Yeah.
Just IPO, like, why not? What's the problem? Big deal. Why?
Well,
just give them $100 billion valuation and IPO right now. We're good to go.
So I did pull some numbers here. So, you know, if you look at the UK-based competitors, Monzo and Revolut, they in 2018, let's see, Monzo had a 33 million pound loss, and Revolut looks like had around something similar, 32.8 million. Starling did somewhat better with the pre-tax loss of 26.8 million pounds. So, I mean, these companies are losing a not insignificant amount of money per year. But I think
not
we've seen not insignificant.
Sure.
Yeah, exactly.
Yeah, no problem.
Well, I mean, so this obviously the industry is seeing, investors are seeing these companies will take hundreds of millions of dollars of capital to get off the ground and really become even a sliver of a real competitor. Maybe it requires billions. We haven't seen that yet. But anyway, I mean, so I think it is possible. I mean, one thing that's worth mentioning here is like the challenger banks are looking for, and I would say Starling's maybe a little more aggressive in a sense about trying to get to break even to show that they can build a business. Because as you were talking about on our last podcast, like unit economics are beginning to matter more, especially if they need to go out and raise bigger rounds. So there are things that they're doing that are working, right? So they've got freemium models. So people pay up for, you know, a nice royal blue card. Not exactly, but they pay up for other things. They pay up for business accounts. And, you know, they're getting into lending there. So it's another revenue stream. I think it is possible if done right and done like with thoughtfulness that they can get to break even and become profitable in not a super long time. We're not talking 10 years out. We're not talking Uber time. We're talking like, I think a couple years.
I mean, I'm not
Am I overly
like,
bullish on this?
I don't know. I don't think you're overly bullish. I think it really depends on the company, and I think really push comes to shove, and they're not. What it seemed like is they're going to try to go public on in London on the London Stock Exchange. But once that roadshow starts, and once those numbers start to come out, and once people get to really nitpick and dive into the numbers and really look at everything, that's what really separates the wheat from the chaff. That's really what goes on. And I mean, I can't make a judgment call on this company because I haven't looked under its hood and seen what exactly its unit economics are. But I mean, right. I think right after our podcast, someone like the head of managing director of Accenture said like the same thing. Like, like we're all like, this isn't new, that WeWork is having an effect, and people are getting tired of just not having a path of profitability, which should be like like it's fine you're not profitable. It's fine that you're looking to grow, but to not have a path of how to get there is something that was tolerated in the market for a couple of years and is insane. And
Yeah,
it's crazy.
it is crazy. I mean, these are cycles, right? I mean, we had the same cycle in 2001, right?
Yeah, which is fine. It's just, but then you're gonna have, and you're at 2001 during that time, you also had companies like Amazon come out, and you had awesome companies being created during those time periods. And there's awesome companies being created during this time period as well. But it's like it's crazy when it's news that like, oh, we're gonna hopefully become profitable, and have a path to profitability. Like, okay, sure, like that should be standard in the world, but. And so the real question, like if they have a business model that makes sense, and then they say, hey, by the way, we actually broke even, and we actually have good unit economics, and we're really starting to get things going. Like, I could see it happening. I could also see them falling on their face and not hitting it whatsoever because the market turns down, or there's a consolidation in the market, or just consumer behavior changes, or business behavior changes, whatever it may be. Like, it's a very, I definitely think it's a point of extreme fluctuation for these very, very large challenger banks.
So one of the things I guess I'm a little disappointed in, I don't really have an answer to this. I'm not smart enough, but we've seen all these challenger banks that for the most part, many of them aren't even banks. And every time we publish one of these podcasts, I have people reach out to me. They're not banks. We're calling them banks because they function as a bank, but yes, many of them don't actually have a license, and they use
hold a place where you can deposit cash that allows you to send money from that point and receive money from that point.
Right. It's a little bit wordy. It's a little wordy when you call it that. Bank-like companies. But I don't think we've seen a lot of, I guess I'm a little disappointed in how little creativity we've seen around really kind of changing revenue models. You have subscription models, but that's not necessarily different than just charging a fee on a checking account that a regular bank would do. I don't know. In some way, we unbundled, and we're starting to rebundle. But the reason it was bundled in the first place was you needed there were some synergies between these products, and you needed all these things to run a bit large financial institutions. And now we're seeing these challenger banks start going around looking for revenue opportunities, and what's coming is they're just really approximating looking like a regular bank. Whether they provide those services themselves or they partner with another one, that doesn't really concern me. But I would have liked to see, or will like to see, if we can get some more creativity. I don't know what manifestation that takes, but that would be interesting for me.
I agree. I have seen some creative models in terms of trying to get revenue from different points, but most of those models are coming from much earlier stage companies. And I think that you sort of get into, and I'd love to hear your thoughts on this. Once you become like a company that's like a $500 million valuation, even 100, like you're 100, 200, 300, and all of a sudden you're pivoting your business model. There's going to be a lot of pressure from your investors, and be a lot of pressure from your board. Like, hey, we're going to go away from this very traditional fee-based model to, like, I don't know, charging per second that you log on to the account, or coming up with some I don't know, like some
like
crazy,
old school ISPs. Yeah.
I don't know, like what, like some like ridiculous out there business model that like that is just very creative and very interesting. And like, if you have board members and large and like banks and financial institutions on your board, like going back to like a Plaid. What if Plaid's like, oh, we're going to pivot, and like JP Morgan and all the banks and the cities and all of them are like, no, you're not doing that. Like, that's just not going to happen. You're going to have to fight your investors. So I think you sort of get, once you get that big, it's hard to reinvent yourself. And that's sort of what Amazon has done incredibly well, is the whole thing that they're always disrupting themselves and that they're always willing to reinvent themselves. But not every company is willing at that stage to try to blow everything up in order to survive, because they see a problem happening right now, because it takes a lot of guts to do that. I think that's sort of might be one of the issues. But
I definitely agree with that assessment. And just as you're saying it, I'm just like, honestly, I don't know how you could get much more creative doing what they do, right? And banks take money in, they hold it, and they move it around, and sometimes they lend it. I don't know what else you could charge for. There have been talks about consumers being able to monetize their own data longer term, but that's on the consumer side. It's just a statement I wanted to put out there. It is hard.
Yeah,
exactly.
It's a hard nut to crack. But someone's going to figure it out. Someone's going to figure it out. Yeah, and then once they figure it out, everyone will just follow that. Probably.
Well, the challenge is like the old school, like big banks, like JP Morgan just announced, it was yesterday, I think they reported earnings. Like they had record earnings since the financial crisis. Like they got back to where they were before the financial crisis. And so like, that works, It's big, it's unwieldy, it's inefficient or whatever, but it works. One thing that's worth mentioning also, Goldman released some data. Goldman has sort of made a commitment to public markets to be, I guess, more transparent in how their business units break down, especially as they're moving more and more into this consumer banking thing. And so as much money as they plowed into Marcus and how much money they plowed into Apple Card, it was interesting. They basically said that, I think they've been, I don't know the exact number, but I would assume it's over $1 billion been invested in the consumer bank. That this year, for the last 4 quarters, consumer banking, which includes, I don't know if it includes Apple Card, but it includes Marcus and Goldman's own credit card, accounted for less than 3% of their revenues.
Yeah.
Right. And so when they started Marcus,
Goldman Sachs is really big.
Yeah, it is really big. So it's unfair comparison, right? Like, but they've staked sort of the future of their institution on the viability of this consumer bank. A lot of their resource, a lot of their money going in. I was even looking at just, today doing some research on who the top talent was on the consumer side. But again, they intended to go into this business that the Marcus would throw off, I think, $5 billion a year in revenue within a couple of years. I think that was originally their thing. I don't know how close they're going to be to that. But again, it's a tiny percentage. I just thought it was worth mentioning.
Yeah, I mean, yeah, Goldman Sachs.
You just can say Goldman's huge. Yeah,
it's freaking huge. Like, come on, like it's funny. You take numbers, you're like, oh my god, they spend so much money on this. You're like, yeah, but it's like, you look at their balance sheet. That's like, it's like a rounding error. It's like like numbers in millions or numbers in billions, whatever, at the top left. And it's just showing like these are huge institutions, and maybe it's a play for the future. Maybe it's a play maybe it's trying to get your hand in everywhere, but. Or maybe it's PR, who knows? But they still have, they still do what they do best, which is, they're still around when Uber's going their IPO. They're still, involved in the roadshow. They're investing in that. They're still doing their investment banking stuff. That's what Goldman is, and that's what they're gonna. I can't imagine that not being a huge part of their business for, unless investment banking just dies overnight, which that's gonna be hard.
I don't think it will. Yeah.
Yeah, probably not. Probably not.
Safe bet. How about it moving to the web?
What, investment banking?
Yeah.
What, to blockchain?
I was thinking more like crowdfunding or something like that, but unlikely. Sure. I think you need the pull of the big.
I say this like a million times to like everybody, which is funny, is that that you have a lot of times you have private companies and they want to stay private and they don't want their information to get out. And so like, this is something I talk about a lot with my friends who are doing like blockchain, like assets. And they're like, oh yeah, let's just make everything open to everybody. It's like, well, then they'd be public companies and they wouldn't be private. Like they want to keep their information private. So like, you're going to move to the web and like make everything fully transparent, like 100% transparent. Like who's going to go there? More likely some Eric Ries gets involved in the LTSC and they figure something out there. No, our best friends over there.
In the remaining time, I'm not going to pitch it. In the remaining time, or you could just do what the Monzo co-founder did, right?
Oh my
Monzo being
God.
one of the, and I know we were prepping for the show. Basically, Paul Rippon, who was the co-founder of Monzo, has quit the UK Challenger Bank this week to spend more time farming alpacas. And I read this and I thought this was totally a story for Josh. I think this is probably a bucket list thing for Josh.
I mean, yeah.
Who wouldn't? Who
Snow.
wouldn't leave their job to go farm
Oh my
alpacas?
God.
I
It's like,
love those animals.
did you watch? I'm gonna date myself. Did you ever watch the Larry Sanders Show? When
Yeah.
he moves to Montana and like whittles for like 3 weeks and then wants to lose his mind. and Letterman, I think, was gonna do that. They joke around, you know. I mean, would I love to like move to a mountain and just like be a lumberjack? Yeah, like just by myself and not have to answer emails all the time. But I mean, I'm proud of him that he's doing that. He probably has some money in his pocket though, which is nice to feed those alpacas.
I actually don't know the plural of alpaca, but he's almost 50. He said he was working in financial services for 27 years and has been working away from his home for the last 8 years. So it took a toll on him. You know, alpacas, you know, it wasn't just like by chance. His wife happened to had started an alpaca farm, and so he joined her on it. But, you know, it's one thing I think that is starting to come to light is the toll that starting fintech companies take on people and families on lives.
Yeah,
You know the grind.
Yeah, I know the grind. My wife, my wife loves looking at the Bucket List family. I don't know if you're familiar with them. It was a guy who sold his company to Snapchat for like 30 million, and
Oh, and
then
he
just
travels around the world and
yeah, he
shares.
just
Yeah.
like he basically just quit. They sold everything and just with their 2 kids, or I think even one was like born on the road. I don't even know for like a what for like he got like YouTube to sponsor it, and he just went off and like, hey, I just like sold my company, and I'm just like, I'm just gonna go have fun and hang out with my kids and let them experience the world for like 2 years. Now they like settled in Hawaii, and now he's doing something else. He turned himself into like a reality TV star. But like the funny thing is that a lot of these founders, these people that like, you know, just love working, you know, as much as they hate the grind, they love it. Yeah, I probably put myself in that list also. And like what you normally you don't see as a founder being like, all right, I'm done now, because like that's not their personality. Their personality is just to continue to
To
build
build
and like,
stuff, right?
yeah, it's just like they're gonna, and I would like he's gonna build this alpaca farm in like 3 months and be like, you know, like Arrested Development, I've made a huge mistake, you know, like Joe Blue. There's more pop culture references for you, Zach. But I can imagine him getting bored really quickly unless he tries to figure out how to scale alpaca, maybe different colors of alpaca to sell to different people,
Materials, different
different
materials.
material of alpaca. You know, maybe figure
Subscription
out
alpacas.
subscription alpaca as a service. Maybe, you know, like could you
This could
imagine?
go a lot of ways. Yeah.
It could go. Could you imagine? I mean, I would love to see that. Just like a crazy founder, just try to like take some board, like like some random business and try to like scale it like you would a startup. I think that's a Saturday Night Live sketch waiting to happen. We should pitch it, Zach.
Totally, I will. Josh, thanks for your time again, and this is always great co-hosting this show with you. And thank you, dear listeners, for putting up with us for another week.
Yeah, that was a little fun at the end, but always good to co-host with you, Zach, and talk about Wicked Plaid. Again, bad Boston accent.
Bye, Josh.
See you guys.